Site on the desk tonight, Karen Feinerman, Dan Nathan, Guy Adami, and Tim Seymour. We're going to get to Nike in just a moment, but first, on a day where the Dow outperformed big tech and rates hit levels not seen since the SVB collapse, we thought we'd ask our traders one simple question. What chart tells the true tale of what is going on in the markets? Dan, which chart did you choose?
All right, so I have a friend, Liz Young. You know, she's on the halftime report. Well, she's actually our friend.
Collectively.
Yeah.
Network.
Yeah.
Brilliant strategist over there at the SoFi. And she tweeted this out. I'm not on Twitter anymore. Someone actually had forwarded it over email, but she tweeted out a chart the other day of the S&P 500, okay, versus where real rates are. So that would be the, interest rates relative to inflation. And I thought this was really interesting because you see that divergence, right? And Guy Adami has been talking about this a lot. He's seen a lot of the performance in the S&P 500 this year is really multiple expansion, right? And so we've often quoted where the S&P 500 is trading at about 19 times on a forward basis, which I think per fact said is above the 5 and 10-year averages, is down there near 18. So something's got to give between where the Fed is bringing interest rates, right, and relative to inflation expectations, and where valuations the S&P 500 are trading. So I think this is a really interesting chart, and I think it could actually be the key to how stocks perform in the second half of the year when we have better clarity on inflation, better clarity on where interest rates are going to go or stay, and really something's got to give with the stock market.
Yeah. Something's got to give, meaning stocks have to come down.
Or you just see, yes, I mean, I think that's probably has to happen.
Yeah. Tim, do you think that's how something gives in this scenario?
I do. And I would point to a chart that's all about rates as well. And I agree that real rates are way too low. S&P should not be trading at a forward multiple above where it was trading pre-COVID. So Dan's chart, Liz Young's chart, all great stuff. I would show that the two-year chart is one that we're within 15 bips of the high for this period, but we're within essentially 15 bips of a 16-year high in two-year rates, another 25 bips or so on that, and you're back to 2006 or 2007. So you're at an extraordinary place here for the consumer. And we saw jobless claims this morning. We saw GDP upward revisions this morning that were probably consumer-based. In other words, they were better than people had expected in terms of consumption level. But I'm looking at disposable income as a percentage, debt levels as a percentage of disposable income, almost 10%. I'm looking at debt coverage ratios at 17-year highs. I'm looking at consumer credit that's up 12.5% over the last 12 months to 1.23 trillion or so. It's just, at some point, this is the problem, that rates haven't been this high and they're going up off of zero. So equity valuations are reflected from the long end, which is what I think Dan and Liz are talking about. And I would just put the pressure on the consumer here. I think the consumer is under a lot of pressure. And I think it means, and we'll talk about retail later in the show with Jerry Storch, but this has a lot of implications for retail stocks and even hard lines, soft lines, and other places that have been defensive.
I feel like it's sort of a companion chart because Guy has the 10-year.
It's interesting that Tim and I would be companions. We went to school together. And remember
Absolutely.
the other night when
Absolutely.
we couldn't hear Tim? Remember how nice I was to him? Remember?
He said he had good hair. He had steely eyes.
great
We could have
singer.
gone a whole other direction.
He's the real deal.
Thank you.
Sorry.
Your chart?
Oh, I didn't realize you were going to come to me.
Yeah,
My chart is, again, it is a companion to Tim's, and it's choose 10s, which is now either side of a 1% inversion. And I think 6 of the last, basically since Fed tightening cycles have occurred, it's predicted 6 basically recessions out of 7. A magnitude that we're seeing now, 100% inversion since the 1950s, has led to a recession, I think, 80-something% of the time. And with the steepness of it now, we haven't seen that in the last, 40-something years. And typically, the range is 15 months from when it started. And we're right there. I think August, September, October puts you right in the window. So, again, I'm not an economist, but I think people were sort of not looking at this closely enough to indicate what it's going to mean in the months to come, Melms.
There's no shot in your head that the markets see or are pricing in a recession at this point?
If the market is pricing in a recession at the multiple
or that
we're
we
trading
had priced in a recession?
Yeah. Listen, is there going to be a soft landing? Have they been able to navigate this? Does this inversion mean nothing? The fact that we've been inverted for about 13, 14 months, 100 basis points, probably headed at this point to 125. Could that be an anomaly? Absolutely. The market says that right now. I just don't believe that's going to be the case.
Karen, what's your chart?
Yeah, so I had sort of a different take on the question, and my chart is just a very long look back at the S&P. And to me, that, what does that tell you? That you want to be in the S&P over time. And when you step back, I mean, sure, there's dips in it. There's the S&L crisis. There's the bubble of the first .com bubble. There's the great financial crisis. There's the pandemic. And I am long into every single crisis. I'm always long. And I just think you can see from this chart just the power of compounding. You want to be in the market. So to me, that's sort of I don't know the squigglies, how they're going to work. I just want to stay long. So that's the chart that is sort of.
I think what you're saying is the most important thing about anybody who wants to invest $1 in the market. I heard you say it on her podcast actually the other day, and honestly, it was great. I know we talked. But you guys did talk about this, and I actually think it's really important. Okay, so the show's called Fast Money here, and a lot of us grew up as traders. Some people grow up as investors. But your point is an amazing one. Let's just look at the last 3 years, right? The S&P topped out in February of 2020 at 3,600. It went down 35% in a black swan event to 2,200 or whatever the heck it is. And here we are now at 4,400. We were 4,800. If you just invested the same dollar amount every month, every quarter, you'd be doing fantastic. And that's the squiggly that you're talking about. But the fast money component of this is like, if you're tuning into this, you like the day-to-day. You like the action. You like the different stories. And sometimes, so we get in the weeds a little bit about that. And I always say to people that if you are invested in the long term, you take advantage of that compounding nature. But sometimes if like a portion of your investable assets is you like the action, right? You like the stories like that. The trading part about it is like that's where you're YOLOing stuff, whether it's crypto, whether it's this or whatever. And so I agree with you. I think that is the most important takeaway, though, of your chart, too, is like you always have to be in the market.
Yes, you always, right. I can't figure out when to sell and then when to get back in and have it wake up for taxes. I mean, there's no shot of my getting that right both ways.
But in terms of your take on what the squiggly does next, it is what?
I don't know. And I don't think it's a monolith.
But you don't care,
right?
That, if the consumer, like as Tim had outlined, if the consumer's weak, right, that impacts a lot of your trades in terms of the retail component of your trades, like a Lowe's, for instance, or, I mean, TJ Maxx, all of these.
Right. Also, though, the market is a forward-looking mechanism, right? And so it shouldn't be shocked every time that sometimes you get in these markets where the same news makes it go down again and again and again. And sometimes the market looks through. And I think generally the market kind of looks through.